Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 97. As always, joined by the three amigos. We got Keith Dicker, IceCap Asset Management, Rich Diaz, new background, Tom Brady of Macro. What's going on?
We're moving up in the world.
Yeah, that's a nice painting.
Yeah, it's probably fake. It's probably fake, but it is nice. It's definitely nice. But anyway, I don't know. Nothing's going on, man. It's like we said last week. It's the dog days of summer. Found a new gym. I've been biking all over Montreal, which is lovely. My friend's in from London, so we had a nice, lovely night. There's actually some great restaurants in Montreal. I'm starting to feel a little bit more comfortable. I need my my petit bourgeoisie.
Are you one of those annoying
niceties.
Bikers that bikes in the middle of the road and pisses me off?
No, but I definitely don't stop at red lights. I'll knock on wood. Hopefully that wasn't the first and last time we talk about biking. But no, I find bikers very annoying too. I think they're slow. They don't pay attention. They don't check their blind spots. And if I was a driver, I'd be furious. But I've been biking in cities since I was 13 years old. So maybe I'm not the right guy to ask. I'm not. That's right. Keith, what's up, man?
Rich has 10 years experience biking.
That's on his Tinder profile.
Oh, geez.
Rich, actually, this I thought of you because this week I had a text popped up on my phone and said, "How are you?" or something like that. And I'm like, "Who is this?" They're like, "Is this Harold?" I'm like, "No, I'm not Harold." It was one of these texts, they're trying to get you.
Are you getting one of
That sounds
those
like a
spammies?
Yeah. That sounds
And
like a scam.
Yeah, of course. And this lady, which I assume was a dude, says, "You sound very handsome." And I said, "You think I'm handsome? You should see my friend Rich."
Oh, God.
And then the lady or the dude said, "Oh, do you have Rich's number?" And I said, "Yeah, as a matter of
No,
fact."
go on. You did not give them my phone number. That's horrible.
I'm already taken with Mrs. Icecap. So Rich, expect a call. It's coming.
Expect a
Call.
call. Give
All
them
right.
give them your bank account info.
And my social insurance number.
It's a dude. Don't forget that.
I don't know.
Oh man, that's tough to top. Well, yeah, I mean, dog days of summer, but there's lots going on all across the world. Obviously, we'll open things up with on the national housing front here. We got the latest data out of Korea, Canadian Real Estate Association. Kind of like a mixed bag on the data stuff. Keep in mind, like any data set, all this stuff is kind of looking in the rearview mirror. So if you look at home prices as measured by the home price index, that climbed 1.1% month over month. So the national house price index is officially down 1.5% year over year. Base effects. You'll actually see national house prices probably next month will probably show a year over year increase. And so I'm sure that will start to stir a lot of media headlines and calls for Bank of Canada to continue hiking and all that other stuff. But just keep in mind, this is kind of looking in the rearview mirror. I think what we're seeing anecdotally in the housing market, other than maybe like the Calgary market, which continues to sort of just hum along, most housing markets across the country are now, again, slowing. I think prices have peaked out again, and we'll see how things progress from here. Mortgage rates pushing higher, which I'm sure we're going to get into in the show here a little bit later on about all the volatility in the bond market. But that's kind of what's happening in your housing front. It still continues to be a story on inventory. There's 3.2 months of inventory on a national basis, and so that's about the long-term historical average is 5 months of inventory for sales. You're at 3.2. So again, still a market that is starved for inventory. And I think this actually is really Yeah, I don't know if you guys were following the news there, but it's obviously a similar story really across all these different markets, right? People are just like holding on to their houses. They're kind of like stuck. They're not moving. And this is obviously happening in the US, right? Nobody wants to give up their 30-year fixed rate mortgage. I don't know if you saw Warren Buffett take, I think, 3 positions in US home builders.
Huge positions with the capital P. I think it's like $800 million or something ridiculous like that. It was an enormous. He didn't just dabble. I think he's been building up a position in housing for a long time. But yeah, I saw that.
But
it's now 0.5% of his total assets.
Yeah, that's right.
No, but it is interesting, right? Because I think, like, if you think about it, like, again, I know US is obviously a different ballgame than Canada, but they're sort of facing a lot of the similar dynamics on the supply front that US home builders have essentially become the only game in town. Like, if you want access to inventory, like, they're the only guys that are actually like building and releasing inventory. Everybody else is just seemingly sitting on their 30-year fixed rate mortgage at 3.5%. So yeah, it's interesting to sort of see him take a pretty big dabble in the US home building.
Steve, are mortgages portable in the US, or are people? Nope. Yeah, so if you're sitting on that 30-year rate, you don't want to leave because you lose your rate, correct? That's the deal.
Yeah, exactly. And so at least in Canada, yeah, like, it's portable, but like, it's not that portable. Like, again, you typically have 120 days to port it, so which means, like, if you sell your house,
there's a limit. That's
there's 120 days, right? So it's like I'm saying, so like, let's say you're in your existing house and you're like, okay, well, I want to upgrade my house. So you have to sell your existing house, lock in your funds. Now you have 120 days, not to find a house, but to like find a house and close on a house, which basically means, like, more or less you've got 2 months to find a house.
But on a 25-year timeline, let's say you have a 25-year mortgage, you can port it at any time.
Yes. Correct.
Okay, cool.
But like, again, there's a lot of the stipulations is that you have this very short time window to port it. And when you're looking at the market and saying, well, there's a 20-year low in inventory in my market. Do I feel confident enough that I can find a house in 2 months or 2.5 months to actually port it and close in 120 days?
Yeah.
So, and again, obviously, if you're upsizing, for example, you got to get stress tested for the extra mortgage amount. And so I just think you're seeing a lot of people, again, the inventory continues to be sort of the bigger story here, surprisingly.
So then, can I ask another question? So I am not allowed to say that. Apparently, got some comments I'm not supposed to ask when I ask a question, but I did it anyways. One of the things I'm seeing on that CREA report is the sales to new listings ratio has started to fall. Can you explain what that means? Like, I know what the ratio means, but it also doesn't mean that, like, so there's inventory is obviously constrained, but there's definitely way less action, or there's a lot less activity as well. Is that right?
Sales to new listings ratio eased. So basically there's like new listings are starting to sort of outpace sales, I suppose you could say that. But again, like, it's at 59.2%. Compared to a recent peak of 68 in April, which is, of course, the top of the spring market. So there's some seasonality to that. Again, the long-term measure is around 55% for this time of year. So it's still pretty elevated. Again, I think, like, let's not, there's no point in mincing words here. I think as people, we're seeing a little bit of a push now. The people that are transacting in the housing market, they've got these rate holds that are now coming close to expiring. A lot of them will start to expire mid-September, end of September. So people that are transacting right now, a lot of them have rate holds at, like, 3-year fix, 4.99. And if that expires, and when it expires, and say, end of September, the new rate for a 3-year fix today is about 6.3%. So you are seeing people with some urgency right now trying to get deals done.
I have another question. Do they split out between existing homes, like months of inventory, and new homes? Because I know in the US, existing home inventory is 3 months or whatever, which is very, very low. I think it's, if not an all-time low, it's just and then to put that in context, in 2008 and 9, you had almost 11 months of inventory. So now existing homes is 3. Yeah, but at the peak it was 11, and in the new home inventory is like 7 months, and then with a similar peak in 2008. So, but it's coming down, right? As you said, in the US, the only way you can get your hands on a home is this new sort of what's coming online, this new inventory, and so you can see that months of. Do they do that in Canada too, or no?
different market dynamics. So like the data that we've just chatted about here is all like resale MLS data. So anything that's anything that is on the MLS for sale, this is what the data is tracking. Obviously, a lot of new construction isn't done on the MLS. It's kind of this black shadow market.
Oh, interesting.
I would say in general, obviously, pre-sale activity, like new launches have fallen off dramatically, right? Because the developers are clearly pulling back and nervous about the market. So like, yeah, I think, and there's also a shadow market of like, okay, units under construction that were bought pre-sale 2.5 years ago that people are trying to get out of, like, that's not really on the MLS either. So I guess there's a little bit of a shadow inventory that you can say, oh, okay, like, could that be a potential, oversupply factor? Sure, maybe. Over time, it's just hard to like reconcile when these units complete and when they all come to market. So, but
here's so as I'm listening to you, I'm phasing out because there's this really bright light just on the wall behind you, and I can't stop looking at it. Do you see it,
Me?
Rich? No, for Steve. Steve, move to your left a little bit. Move to the. There it is. Do you see it, Rich?
That's right. What is that?
It goes on your forehead sometimes.
Is that a hole in the?
What is it?
Yeah, I don't know what's
Great.
going on there.
Great podcasting, Keith.
Yeah, Keith, thanks for paying attention, buddy. You're really dialed in today.
Well, you were talking about like inventories and they move up and down, and it's the summer, it gets distorted.
I do have a
What
good
else?
story.
I love stories. What do you got?
This is so I had a Loonie Hour listener, I should say. Yeah, super nice guy. I think he was at our live event there as well. But he calls me up and he goes, "Hey, I've got this, I've got the story for you." And so he says, I live in West Vancouver and I live in the British properties, which is like, for those that aren't familiar, is like incredibly expensive real estate. And it tends to be really since like over the last, let's say, decade or so, it's kind of become a mecca for like it's like the foreign doormat. Like it's just a dumping ground for offshore cash. And so anyways, like mega mansions up there. And so he goes, I was walking down my street and, and again, a lot of these houses in the British properties tend to be vacant or semi-occupied kind of thing. So he goes, my neighbors, there's trash all over and it looks like, the garbage collector didn't pick up the garbage, or maybe a bear got it and tipped it over. So he's like, I went to go like start cleaning up some of the garbage that was spilled onto the street. And he goes, I just like happened to like one of the first things I picked up was a letter from CRA. And he's like, I didn't like intentionally dig through. He's like literally just like a CRA thing. And he goes, sure enough, he goes, it was a check from the CRA for the Canada Workers Benefit. And, it was like they're doing like quarterly payments now. I think anyways, this like, it was like a $200 check or something like that, $250.
Yikes.
And so for those that aren't familiar, the Canada's Worker Benefit is a new program that the Trudeau government launched. And this is a quote from Freeland when it was launched. It says, the Canada Workers Benefit tops up the income of up to 4.2 million hardworking Canadians because no one working full-time should be struggling to put food on the table or pay their rent. So they started sending out these GST or these quarterly checks. And so this guy...
What's the average price? What's the average price of one of these houses?
I can tell you. So I think the guy, I got like evidence of it. So this isn't just like a bullshit story. I have evidence of.
Unlike most of my stories, right?
Yeah. So it had the address of the property. I looked up the address. The house is tax assessed by the BC Assessment Tax Authority at $12 million.
Nice.
So this guy's getting, and apparently he says that the house is actually like vacant. Nobody really lives there. So
I mean, to his credit, he didn't cash the check, so maybe the system is working just fine.
yeah. So the guy in the $12 million house got. I'm glad to know our the Loonie Hour tax dollars are funding.
So this is an example of an income, so a government benefit based on an income test versus asset test, right, Rich?
That's right.
Yeah, that's
you know
right.
how I feel about assets versus income.
It actually
I
says
know.
it actually said on the sheet too. It was like, so the declared income for this individual was 33,000.
Yeah, of course.
So
It's bogus.
anyways, obviously he's
So did he cash the check? Like, did he just scribble a number on it?
I didn't get involved in that, but I'll just leave it there anyway. So this is what's happening. We've got checks being sent out in the mail to multi-millionaires here in Vancouver. So they
good.
can pay their groceries.
Oh, good. One day we'll talk about UBI and how effective that is as a strategy. But I think we should talk about the inflation imprint.
Well, I mean, this partially comes to the inflation. If the government is hell bent on continuing to send out checks to anyone with a pulse, inflation may.
So the government is borrowing money to give to people to spend to help bring inflation down. Is that the story?
That's the plan.
I mean, some people genuinely deserve some government help. So let's let's not.
Yeah, that's true. And people are going to get all
upset. Not the person who lives in a $12 million house. That's ridiculous.
But anyway, so inflation ripped on the news, of course. So the coming into this inflation report, the estimate was for a 3% headline inflation. You remember last month we had 2.8% year-over-year headline inflation. Base effects, of course, helped us get us there. Base effects are now pushing us back up. But nonetheless, we were at 2.8 last month. The expectation was for 3%. Headline inflation actually came in surprisingly at 3.3. So a huge surprise to the upside. Rich, I don't know if you have any commentary on that.
Yeah, I mean, let's just go over it normally. I mean, so there was one very famous politician who bragged about the 2.8. So I thought it was quite delicious that it quickly reversed on this person. So it rose to 3.3. I have my Bloomberg working today, so we can quickly see what's going on here. I thought I'd be able to do it quickly, but I guess not. So electricity.
She unpinned it from her profile, by the way.
Oh, interesting. Okay.
So anyone that's paying attention, Krista Freeland was out, obviously promoting the 2.8 headline inflation, lowest in the G7, back within the Bank of Canada's target range. She had that pinned on her profile. Honestly, it must have been up till like a couple hours ago. So after the 3.3, file like a day and a half later.
Oh, your mic got unplugged. But anyway, so I mean, this is why you don't take victory laps with one data point. Surely, someone should have told that. But anyways, so I mean, listen, it again, and we shouldn't take a victory lap on this either. I mean, the reality is this series, it does fluctuate. There is some stuff that goes on. There are specific items that, jump all over the place. For example, electricity prices rose in Alberta, increasing 127% in July year on a year over basis, right? So that those kinds of things happen. The mortgage cost jumped 30% year on year. Should surprise nobody. Stuff that I thought was interesting though was, you have some big sort of an increase in services to 4.3. We've talked about how that's sticky. And then also we always talk about sort of the core, the preferred measure, the three preferred measures of core inflation by the BOC. And why I'm bringing that is because after falling precipitously, so from the mid 5s and whatever 6s, let me just see when was that exactly? I think like late last year, it fell really quickly and they stopped falling. So to me, that is the big takeaway. You have the core measures that sort of do either the trimmed mean piece CPI, which is basically you take out the edge numbers in order to get a measure of central tendency. There's another one, I can't remember there's the common one, which is basically a model. And then there's another one. Oh, yeah, and the weighted means. That's like a different one. Anyway, I forget what they all do now.
But the point is off a bit.
But that's the key thing. So they were falling a lot, and then now they've stopped falling. And so that to me, it's always about it's not so much about sometimes it's about the direction, yes, but it's also the change in those numbers and how they stop or reverse or what have you. So I thought that was sort of really interesting. And again, services, just to belabor that point, I think, so we'll see. I think it's you mentioned the base effects. I mentioned sort of some of the sort of the blow, like sort of the, hitting my head on the side of the swimming pool and then coming back. I think that's happening. Watch out for energy prices. You're seeing a lot of energy prices sort of head higher. I don't think this is over. When I mentioned that a year ago or 6 months ago on Twitter, everybody thought I was absolutely nuts. I just think this inflation is entrenched for multiple number of reasons. And I'm sure Keith is going to tell me how I screwed that up.
No, I
Keith?
think you're right on. Yeah.
Okay.
So
good.
do you think then that they'll, like, we can talk about, what the Bank of Canada's price at doing
Right.
and what the expectations is it right now, by the way, like there's a huge divergence between Bank of Canada expectations and the Fed.
Yep.
So if anyone has access to those products to trade it, hey, you can play that if you want to. But like I'm hearing you explain it, and I'm hearing that you think they will have by the Bank of Canada, will have the opportunity to stay hawkish or even start raising rates again. That's what I hear,
my view.
right?
Yeah, that's my view.
On
I
the
think I think they
Bank
have
of
to.
Canada,
Sorry.
Rich.
Yeah.
Yeah.
Bank of
Go ahead.
Canada.
Sorry.
Interesting. What's the market?
Yeah, I think they have to.
What's the market currently priced at? The September 6th, I think, is the next meeting. By the way,
September 6th is the next meeting. And right now, basically, no price, no hike. It's like a 33% chance of a rate hike, basically, which means the way it's calculated, it's basically like, but there's a full hike priced in basically by the end of this year.
one more.
One more by the end of this year.
Yeah. Look at you with your Bloomberg terminal.
I
Eh,
know.
Keith? Look at this guy.
I know, like I'm not even needed anymore, right?
Moving
Like,
on up in the world.
like I'd be like Michael Cera. What in Arrested Development? Remember, he just put his head down and walk away.
Yeah.
Yeah.
I don't know if, hey, Rich, you'll appreciate this. This isn't the official Stats Can report. So this isn't like, so Stats Canada says, Nova Scotians saw prices at the pump increase by 14% in July compared with June. The introduction of the federal carbon levy in the province and higher wholesale prices contributed to higher gasoline prices.
Yeah, that's what taxes do. They raise prices for things. Well, but I mean, like, listen, you can love the carbon tax, you can hate the carbon tax. To pretend it's not inflationary is just, you're detached from reality. You can think it's the greatest policy in the world. It's still inflationary. You're literally adding to the price of the thing that you are buying. So I don't get why there's.
Well, this is, but this is kind of the issue, and this is not just a Canada thing. We know this is happening in most of Western democracies, which is, these governments are basically moving in the opposite direction of these central bankers. The central bankers are obviously trying to lower inflation, start to kill demand, and governments are continuing to sort of basically essentially print money and mail out checks, and
that's really frustrating for the central bankers, because they're definitely slowing the flow of money, supply into the system. I mean, there's lots of data that show that, but yet that's being offset on the fiscal side, by the enormous deficits of Canada and then the Americans and everyone else, for example. So if you're a central banker, you're getting slammed for not bringing inflation down. Like, I would just love for one of them to lose it and say, "Hey, listen, it's not our fault. We're doing everything we can. It's these guys on the other side of the street. They're the ones you should be yelling at, because they're the ones that are causing inflation, to remain sticky." But with this current number, that you were just running through, Rich, I'm trying to see it here now as well. So it's still trending. Like, a lot of people look at the headline number. So what's the headline?
3.3.
3.3.
Yeah, 3.3, and the month before it was 2.8. That's year over year. So like, it's still going up. But if you look at the core data, like it's still trending in the right direction. Like it hasn't achieved escape velocity again. So the Bank of Canada will look at this and say, okay, we're now expecting all these, going from 0 to 5 in, 18 months, Steve, I guess, something like that.
Mm-hmm.
We're going to wait to see what kind of a bite that has. So maybe the numbers will start to get a bit softer. But the challenge we're going to have, I was chatting with a guy yesterday, and so he drove up the coast of the American coast. And he was just talking about like the price of everything everywhere, not just in Canada, but down in the US. And we were just talking about like, how does the average family afford this stuff? I mean, the comment he made was, we pulled into the Chick-fil-A to get, a quick lunch, and, $70 later, we leave. $70 for takeaway, chicken sandwiches. But I think they are good.
Yeah.
I hear they're
very
good
things about Chick-fil-A.
Yeah. And Popeyes is the other one, right? With the
We
has a
don't
real nice.
have that here, I don't think. Anyway,
I had one before. I always try to make that up. I lost my train of thought now. We went on to
There's a new
food.
said it was really
Popeyes opening
expensive.
downtown Vancouver. Fun fact.
no, that's not what he was saying. He was saying that families are having a hard time. How do they afford spending that kind of money on food, etc.?
Yeah, absolutely. And so what's happening now, and you're starting to see some more data points come out with this. Households accumulated a lot of savings during the pandemic because you couldn't spend it. You couldn't go anywhere. Government of Canada checks were showing up on your front lawn and stuff like that. But now we're likely at a point where the savings is starting to run out. And again, like I'm in a camp, I believe, by default, a recession does happen next. This is the way a cycle works. When it happens, is it this year or early next year? We don't quite know yet, but we are set up for this. I think it will be a dramatic slowdown because right now everyone feels, nice and warm and fluffy about it. And it's nothing really
Soft landing.
Yeah,
landing.
all that, or no landing and all that. But it is going to bite. And, you get that from going to the Chick-fil-A. That's the story here.
It's not just that. It's my sister. So my sister, who never gets a shout out on this show, although she probably should because she listens every week and I love her. She works in PCG, so consumer goods basically. And she sells, let's say, a discretionary product. She works for a company that sells products for animals. People love their animals. They spend incredible amount of money on animals. Ask Steve's wife. But the point is like she's starting to see, she has an online business naturally. And she's starting to see those baskets change ever so slightly, where people are starting, instead of buying, a $20 dog toy, they're buying a $15 dog toy, or $10 dog toy, or whatever it is. The baskets are changing, and I think we are, even though the market, as you said, Keith, is priced as if we're not going to have this hard landing at all. I think that there's already starting to see some real changes in people's attitudes and habits, and the substitution effect, which we've talked about before, and other ways that people are expressing their concern over what's going on in the economy. So
next we have, of course,
we had Canadian Tire, right? Which we chatted
Yeah.
about last week, which I think is the brilliant example, which is, their CEO coming out and saying, we're seeing it in our numbers and in our data that's showing the consumer is really pulling back.
Remember, they I think, what was the wording? We're revising our financial aspirations.
So good.
That's outstanding. I've never heard that before. That's really sharp. Whoever came up with that, anyone at Canadian Tire head office, whoever came up with that, please connect with us, because you deserve a Loonie Hour mug for that.
The Loonie Hour is also pulling back on their financial aspirations here. These tough economic times.
Yeah, that West Coast swing took us for a hit, I think, at the end.
That's right.
That was, but that's because of Rich at the bar every night. Was but guys, with the so back to the Bank of Canada CPI story and Chick-fil-A and all that stuff. So right now, so as Rich, you just mentioned, the expectations for the Bank of Canada, they will hike rates by 25 points coming up.
Not coming up by
the end of the year. Excuse me. Sorry. By the end of the year. If I missed.
Yeah, I didn't mean. Yes, Your Honor. I didn't mean to mislead the bench. But why don't you swing over to the American WERP screen? And in the Bloomberg world, that stands for what's the WERP stand for?
I don't know.
World interest rate
probability.
Yeah, that's cool. So the interesting here is that the market is expecting as the Brits would call them, the Yanks. They're going to start cutting rates aggressively, starting next spring, I guess we're looking at, Rich, like next May, June, something like that. But it's a huge difference, like almost down by 100 basis points, towards the end of next year. And so the market expectation is that we now, again, we had a dovish Fed. And this is very important because, remember, everything is linked together. What was the first animal we talked about in the room, Steve?
The panda.
Yeah, the panda a few weeks ago. And then the other guy in the room, not the fish. We came with another name.
The fish in the room.
The ninja. I don't approve of, but anyways.
It was the ninja in the room. And then we have so the reason I bring this up, because remember, everything is connected, and we love to use the expression which we coined. We is me, by the way, not you two. Global risk has been synchronized.
You coined that. Okay, congratulations.
Yeah, thanks. You should get that on a t-shirt. That would work out. And but right now, though, if the expectations are for the Fed to no longer hike and to cut, that's what the Chinese and the Japanese need to hear. Because remember, China, they cut rates last week. I think it was 15 basis points. That's what they did. And the Japanese, they have pretty soft numbers. Both their currencies are coming down quite aggressively. If the Americans hike rates again, that then becomes another double whammy for both China and Japan. Because on a relative interest rate basis or perspective, now it's even more rewarding, where you get paid more, to stay in the US as opposed to going to those countries. If you look at, so next you look at, okay, what's the data in the US? Is the economy strong or weak? And again, the economy is doing pretty well. Steve or Rich, pull up the Atlanta Now GDP.
It's doing super well. It's at 5%. I was looking at it. So let's explain what an Atlanta Now thing is, maybe, if that's okay, or else.
Yeah, I'm kind of curious how much.
Can you do that?
You put into that.
You're better at the boring.
Yeah, sure. So something I'm better at the boring. Okay. So the Atlanta Now, it's called the GDP Now, actually, and it's from the Federal Reserve Bank of Atlanta. And we've talked about there's different reserve branches, and each sort of specialize in different things. Dallas does energy and whatever. Now my computer is lagging, which is really great timing. But basically, so what they do is it's called GDP Now. You can Google it; it's free. And they basically they use they amalgamate or funnel loads of different types of data. So everything from manufacturing, employment data, inflation, survey data, housing data, on and on and on. And they basically generate a sort of real-time predictor of US GDP. And so then on the website, you can see they have sort of the blue chip consensus is what they call it, which is sort of an aggregation of all the economists' forecasts, expectations, whatever. They show the range, and then they have their own sort of Atlanta Fed GDP Now estimate. And obviously, it moves as new data is presented and available. And right now, Keith, it's at basically 4% and rising towards the end of sort of this quarter, which I'm sure you're going to tell us why that's really interesting.
Yeah, I mean, that's like 2005 numbers, I think. Like back, I don't remember.
That's real
then.
GDP. Sorry, I interrupted you, but it's a real GDP. Just in case.
Yeah, the economy was flying back then. So the point is, if that's what Q3 data clocks in at, for the American economy, that the Fed has to stay hawkish. They have to raise rates again. And so then that's going to put a lot more pressure on China and their currency, their capital flow, trying to keep things in check. Same thing with Japan. So again, you always have to understand and appreciate which way policy makers are moving with interest rates, what they're going to do, what's expected in the market, and what the impact can be from one country, to the other. So, with Canadians right now, again, they're really priced to not make any moves next month. I'd be shocked if they did anything in September. And by the way, didn't we do the live survey in the Vancouver event for the September move?
I voted for a hike.
I think the market was calling for a hike, basically. The audience.
I think it was 50-50,
No,
wasn't
50-50. That was what was cool about it. It was actually roughly 50-50. I mean, this is not exactly scientific here, but,
Yeah, I said no hike, and you said a hike, which means Steve will be right, whatever the answer is.
No, but Steve agreed with
We're never right. You and I are always wrong with this thing.
No.
Yeah.
But wait a second. Sorry, to Keith. Let me just go back one step. You said the Fed minutes were dovish, and what's funny is, and I think people need to understand.
No, we didn't talk about the minutes yet.
Oh, we didn't. Oh, okay. I thought you said. Okay, sorry, my bad.
Man, you guys are all over the place today.
What? I thought we were doing a good job today.
It's a bit sloppy, truthfully.
Oh, okay. All right. Well, let's.
But at least,
Keith,
Rich, together, at least you and I don't have this bright laser light on our forehead like Steve. If you're on Spotify, you're missing out on this.
Yeah,
this is
right.
I still don't know what you're talking about, but Eddie,
yes.
is this
but
not
back
coming
to the story. It's about the Fed the expectations for them not to raise rates. And what I'm strongly suggesting here is that they will raise rates. And then that's more of a risk-off market event. It just starts to accelerate, the current market move, which is risk-off. So then the Chinese, I mean, like they already cut rates. They're trying to, solve this bad loan problem they have. We've already talked about, the employment population is in decline. The number of unemployed youth, whatever the age cutoff is for that, like that's struggling.
They discontinued that data set after Rich called it out.
Oh, you're so right. Yeah, they did that.
It was definitely my fault. I apologize.
Yeah,
everybody.
G's been listening to the Loonie Hour.
You know what? The
Panda in the room.
lady or the dude who texted me, I think he is in China. You're marked now, Rich. You're in trouble. But in China, one thing they can do, like they can pass out stimmy checks, like what they're throwing on the lawns there in, what was the neighborhood? The Royal neighborhood? In Vancouver, Steve. What was the
British Properties?
The British Properties. There you go. But if they're afraid to do that, because if they do that, then people will get used to receiving it and they'll demand it again the next time. I'm just pointing out, we're set up for the Fed to raise rates here in September, a couple of weeks away. Jackson Hole is coming up next week or the week after. And like that could be like a precursor to it. And we're set up for some pretty cool market events. If you're into cool market events.
Yeah, no, I'm kind of curious because I mean, this is kind of like setting up for, I think, a really unfortunate landing is what I'll call it. But global yields reach a 15-year high as rate hike worries build. And so is this kind of like the last gas, right? Which is like everyone's like, holy crap, like the economy's not rolling over. GDP now cash and Atlanta Fed are blowing out. We got to get even more rate hikes in. Yields obviously pushing even higher. And to me, I feel like this is just like at some point, this just has to suffocate markets and the consumer.
Well, I'll jump in there. I think I agree with you sort of in principle, but what's actually happening is market sentiment's actually weirdly improved. So I mean, wait, maybe not. Let me rephrase that. There are ways that you can calculate or that people show sort of sentiment. And there's like literally surveys that they do. For example, one of the charts I was looking at today, which is the American Association of Independent Investors. I got that one right. And they basically ask a bunch of these people, are you bullish? Are you bearish? Are you neutral? And to what extent these people are, and they aggregate these sort of surveys, and you can over time you can see what sort of happens, and they've been doing this for a long time, so it's relatively reliable. Maybe it's lagging, maybe it's not, but what you're starting to see is actually there are fewer investors that are very, very bearish. And so to me, that's like a really, really sweet setup for disappointment, as I think.
Well, that's what I'm saying. Everybody's now like capitulating and being like, everybody coming to this year was like recession call. Like I don't think there's one person that wasn't like, we're going to have a recession. It was so consensus. And now the consensus is clearly shifting to like, yeah, I guess there is no recession. And
but that's a dangerous game. Yeah.
Yeah, totally. And this feels like the sort of the last bear capitulating as yields blow out higher here.
So I have access. So one of the sentiment models that I use is from a firm. It's called Ned Davis Research. So they have a daily trading sentiment composite. It's Davis 265. If anyone is using their research and models, so right now it covers stock market sentiment, and it's the model now. It's not in the excessive optimism zone or the extreme pessimism zone. It's sort of in the middle. So like when we're managing money, you have whatever model or tool you're using to help you make decisions, you have that. And then you overlay sentiment on top of it. You never make a trade just based solely on sentiment, because sentiment, it can wear off over time. Yeah, it's fickle, But right now, I mean, like market has been a bit soft over the last 5 days, like both equities, the currency world, and then the 10-year, which is, I think, Steve, you didn't use the word mullered, but it is getting mullered, I think, pretty good. But this sentiment model is just saying, hey, this could get even worse than we are now. Because think about it. I think equities are off, what, 4% from the recent high?
Yeah,
That's
Nasdaq's
crazy.
had 3 bad weeks in a row.
That's crazy for markets to be.
Keith, I got a question for you on the sentiment side of things. I think, and Rich, correct me if I'm wrong, but I think U.S. real yields, for example, I believe are the highest since 2008, 2009.
That sounds right.
So you're actually being compensated to hold, let's say, long bonds.
Yep.
Yet nobody wants them. Which is funny because if you think, and then you go back to, let's say, 2015, when rates were zero, and everybody was buying bonds hand over fist, couldn't get enough of them. And now, now you're actually being compensated for the first time in a very, very long time. You're actually being paid a real return, a real compensation on bonds, and nobody wants them.
Well, that's because the U.S. is running a 6% budget deficit. So some other considerations, but Keith, sorry, go ahead.
And again, just strictly from
and there's a difference between from like a retail investor or a private client or a smallish type fund. You can go, yeah, you know what, this is a good deal. Let's do this. It's it's kind of similar if you bought long bonds in 1982. That's like buying, I don't know, Apple stock at 5 cents or something, right? But right now, though, as Rich, you just mentioned, there's a lot of supply coming online in the treasury world. Same thing with Canada. Like, we're pumping out more debt than we're issuing more because we need to borrow to cover that big deficit and debt rollovers. China is selling treasuries because they need dollars. That's adding to supply on their market. Japanese are selling treasuries as well because they need dollars. So it can get a bit worse, maybe, but maybe the trade here, we and this is not any kind of strong investment suggestion or anything, but the long yields can probably go a bit higher, a bit longer here, and it's something we're watching closely, and we could take a position soon, or we may have already taken a position. Yeah, it's for the public, of course, right? But when we do it, we'll share with you. But I think you might, Steve, I think you've identified it, an opportunity there coming up. But that would be in the government bond world. I would not buy credit. I would not buy credit with something Rich might own.
But this is a case of fiscal dominance, right? Which is the government spending is actually overwhelming. The supply of government debt is overwhelming the demand on the private side.
But not all government spending is created equal, right? So giving checks to a person who lives in a $12 million house, that's dumb. Spending on, in my view, anyway, spending on infrastructure and that kind of stuff is not, or less done, a lot less done. And I think that
that's an investment, right? One thing is the spending, like income statement item. Another one's a balance sheet,
right?
Item.
But the reason I'm bringing that up is the reason I'm bringing that up is because there's other parts of the economy. We were talking about consumer in Canada that aren't doing so hot. Well, one part of the economy in the U.S. is actually doing really well is spending on manufacturing. So we've talked about gross fixed capital formation, and that's split up into two. You have structures and equipment. You're seeing a resurgence in that and the spending on that, fueled by the IRA, the Inflation Reduction Act, which is, of course, an oxymoron in the name of the bill, which we correctly called out, by the way, a very long time ago. But my point really is that there's a huge amount of spending in some really key infrastructure spaces, the energy space, whether you like it or not, that's happening. Manufacturing space as a function of reshoring and onshoring a lot of these businesses. And if you look at we talked about bellwether stocks a lot. If you look at stocks like Caterpillar or Komatsu, or there's another company called Eaton that do these big infrastructure projects. So actually those stocks are telling you that there is no recession. Those stocks are actually confirming what you're seeing in the GDP nowcast. And that's what makes obviously our job difficult and obviously fun too. But it's not all, it's not straightforward at all, I don't think. I don't know.
Well, anyone that's got, a very, very strong opinion on the direction of where we're going in the next 6 to 12 months, I think you should be very cautious on that one.
Yeah, but
Keith knows though.
Keith knows exactly where we're going.
I just can't stop staring at the laser thing right now.
It's G's laser.
I think it's gone now.
Can we talk about
Yeah.
the ESG thing?
I think you've
Yeah.
earned it.
It's kind of, yeah, absolutely. And then maybe it ties in with the Twitter fight that you mentioned earlier.
Oh yeah.
It's all,
we can get to
everything
that.
is tied together. I think Steve's story might resonate more with more
I'm
people
listening.
let's go with Steve's first.
Oh yeah. So there's been Rich, you mentioned it actually just earlier on in the show, right? As we were walking through Canada's CPI inflation print. So what was it? Electricity prices in Alberta were up like 146% or something ridiculous
Something
like
like
that.
yeah.
So basically what's been going on there is the Alberta government, I believe, has actually been subsidizing electricity costs. And so again, I don't know all the specifics of it, but basically they've now removed that sort of subsidy, and obviously that's been blowing out. And at the same time, there's been these discussions, or not discussions, but demands from the environment minister here in Canada, Stephen Guilbeault, or whatever, however you say his last name is, but basically telling Alberta that they essentially need to electrify their power grid by 2035. They basically want it to be like a net zero power grid by 2035. Anyway, so him and the premier Danielle Smith have basically been going back and forth very publicly on Twitter and calling each other names and basically squabbling about how to reduce emissions in Canada. So it's actually been very, very entertaining if you're following any of them on Twitter. They've been going at it. But basically, Danielle Smith, she put out a graph 4 or 5 days ago, showing critical points, for example, last winter where they barely had enough power to keep their homes and businesses running. And so she basically says, check out the chart where it shows there was basically near zero wind and solar during those winter months. And so natural gas is actually what powered Alberta and kept everybody warm during last winter. And so she's been really pushing back on the federal government's requests to expedite the green transition, which again does not go over well in Alberta.
Well, it doesn't go over well in any country that ascribes to the laws of thermodynamics and energy density. I mean, this is what happened in Germany when you had a couple of days last winter when they got squeezed by the Russians, and they have an incredible amount of capacity for wind and solar, but they didn't get the right environmental conditions for it, and they had to basically buy nuclear power from France and natural gas from their neighbors, etc. This is, I mean, yeah, we're going to see more and more the fight between dogma and reality, and I'm cheering. I'm on the side of reality, really.
So he's actually, and this kind of leads to the environment minister, Mr. Guilbeault. There, he's actually flying to China this week to talk to Xi about the Loonie Hour podcast and to get him to comply with the ESG.
Okay, so here's a contrarian view that you're not going to be surprised. That's his job. His job as an environment. If you believe, I mean, I don't agree with the policy, but I don't agree with the criticism of him either. Because if your job is as an environment minister, and that's your view, again, I don't agree with that view, but that is your prescribed view. Naturally, you have to go after the biggest polluter, by far the world's biggest polluter, and to get them on board, right? So I don't get.
Well, let's walk through this scenario.
Naive, but...
Let's walk through this scenario. This guy's going to fly to China, and he's going to say, "Hey, Mr. Xi, can you cut the coal there, buddy, and put up some more solar plants?" I
don't agree with him, but I don't agree. Of course, I agree with you in the sense that it's a fool's errand, sure. But he is the environment minister, and their policy, as misguided as it is clear. So naturally, he should get on a plane and go and try to, I don't know, twist G's arm or something. It's ridiculous.
This guy's gonna get squashed like a bug.
I don't know, man. I'm with Steve on this one. I mean, you'd have to know your expectation should be that the value added for taking that trip and that meeting, if he actually got the meeting, I'd be surprised if they did, is purely for domestic political purposes.
Okay,
that's my belief, right? And maybe, but Rich is right as well, that, hey, this is the policy. So hey, this is what he's going to try to do. But this, when you go back to, it's probably not the right policy.
Of course, it's not the right policy. Wait,
Rich,
Yeah.
how many new coal powered plants is China opening this?
it's like 102 like gigawatts, which is like roughly 50 or 60 new power plants, more than every other country combined.
And then you've got what oil demand hit a new record high too as well.
Yeah, it's about 15
last
million. Yeah, it's rising quickly. It's I can't remember right now. I forget the number offhand, but I think it's about 15 million barrels of oil a day. I mean, China's one of the largest producers of oil as well. So we've talked about it's U.S., Russia, Saudi Arabia in whichever order that is. Then it's Canada, number 4, which 4.5, and then China's like right below that with like 4.4. But the problem is they consume way more oil than they produce, and so that's why they're, et cetera, et cetera. That's for a conversation for a different day. But
also, this Mr. Guilbeault or Premier Danielle Smith, if either of you are listening to this show, you are welcome to come and have a civil debate on this podcast. Or conversely, I'll have one of you on each. So there you go. There's no
debate. We don't even need a debate with them. I'm just curious, really genuinely, about
just a conversation.
Think. Yeah, just a conversation.
And I think
we always say we love to hear both sides. I mean, there's arguments to be made on both sides, and you're welcome to come and share those views.
And maybe that's where the value is now between this conversation on Twitter, between Alberta and Ottawa with this, because it should. Some people might say, on the one hand, well, that's stupid for that to be taking place on Twitter. And to be fair, a lot of conversations on Twitter are pretty stupid. Let's just be fair. However, Twitter, or X as they call it now.
Oh God, I refuse to call it X.
Okay. I don't know why. How do you want to respond to that? I mean,
carry on, keep going.
Okay. But however, it's also allowing the public to see that, hey, this conversation, it is taking place. People should be aware of it, no matter whether you agree or disagree with it. So instead of it getting filtered through, through the CBC or CTV or the Globe or, whichever media legacy platform you're looking at. So I think it is, I think it's great. Are we back to liking the Globe and Mail again?
Yeah, we
love them. They're great.
Should they're advertising again? Who do we like and not like now? I forget.
No, the Globe currently doesn't have an advertisement with us, but Globe, we're open. We're waiting for the
but not the Canadian Tire though. Not those guys.
I like them. I like Canadian Tire. I support them.
Who didn't like the Canadian Tire?
Steve doesn't like Canadian Tire.
I think they're not good. Chick-fil-A,
You're a bad
though,
citizen.
on the other hand.
I've never had a Chick-fil-A. Okay, can we finish with the ESG, because I gotta go.
Finish up.
Back to Steve's sincere invitation to anyone in this at Alberta, any other province, in Ottawa. I think it is.
Who's been out as well in recent weeks as well is the Premier of Saskatchewan. He's been out very aggressively against. He seems to be backing up Alberta and is not happy about the demands of the federal government. So there you go.
I hear they have great lawn bowling facilities in Saskatchewan, so we need to go out that way next. Rich, why don't you finish up with the EST, which really does complement this conversation as well, I think.
Well, I warned, when we had the discussion, I warned about the issues that would sort of inevitably creep up. And one of the things that I warned about was worries about performance, whether or not ESG, and for those ESG products or ESG rankings and ESG ratings and all that stuff had any actual benefit to their clients. I made the case that it's basically just marketing. And I stand by that view. And today, or this week rather, S&P Global, which is a rating agency similar to Fitch and Moody's and the one from France, which I don't remember, they said they stopped handing out scores to corporate borrowers on ESG criteria at the time of rising questions about their utility. Now, the article, of course, went on to stress about the political blowback that we're seeing on S&P Global, but I think that that's a red herring. The real issue that they're having is that it's not at all clear if just because you have a good ESG score that you are necessarily a better credit, or that you at all subscribe to any of the purported benefits that these claims are making, whether you are or not good for the environment, whether or are you're not good on social causes, or whether or not you have a governance that is appropriate for that type of credit. And so they've stopped publishing it. Now, other credit rating agencies still have them. So Moody's is saying that they're going to stick to their guns. Again, I think this will be casted to the annals of history, and in 10 years from now, no one will really, hopefully, I should say, no one will think about this. But I think it is really interesting that a huge rating agency basically has stopped ranking or scoring the credits that they assess on these types of issues. And then the other story, which I thought connected to this, was a little less important, but I think equally as interesting, which is a New York City pension fund is being sued for a breach of their fiduciary duties. And you say, why? Well, it's because they sold billions with a B, billions of dollars of fossil fuel assets, basically stocks of oil and gas companies. This is at a time now there are good reasons and bad reasons to sell oil and gas companies. They haven't actually performed that well, frankly, in the last 6 months or what have you. But they are making money hand over fist, and their free cash flow yields, so basically the cash after you strip away any sort of capex or sort of capital expenditures, are at basically all-time highs on my chart. And so these companies, and they're buying back their shares, and they're paying really high dividends. And so there's now a lawsuit, which will take, I'm sure, a long time to flesh out, but you'll stay tuned to the Loonie Hour and we'll keep you posted. But I just think this is just an ongoing situation where people who say, listen, you cannot impose your political view on the world via the back door, which is what this is basically. And so, Keith, I thought that was really interesting as a follow-up, and thought it was worth mentioning.
I love that. I need to say two things before we run. One is a public service announcement.
Okay. Go on.
You got to repeat the story.
I already told them Popeyes is opening in Vancouver.
No, it's way more important than that. Say no to central bank digital currencies.
Oh, yes, of course.
And don't be fooled by the Bank of Canada announcement. That's just a subtle smoke screen. So
you
stay
think so,
on
really?
that. Yeah, of course. Absolutely. Whoever wrote, actually, I was going to try to find this week who wrote the article. And I bet you it's someone that shouldn't have done it and sent it out. So anyway, say no to central bank digital currency. That's the public's. And the other one's an ice cap not a major announcement. Next week or the week after, we're going to have the annual ice cap beer bash or drinks in Halifax. Anyone who wants to attend, just send me a note either on Twitter or an email, and we'll let you know the details. Again, next week or the week after. I'm not sure which one. Rich, you're invited as always.
I know I'm invited, but it's a Thursday. I can't do it a Thursday.
You don't even have the week picked out. It's not very helpful.
It's next week or the week after. It just depends on other things.
How he's feeling.
Yeah.
What an announcement. What an amazing, well-coordinated beer garden.
Well, I have other work commitments that I might have to
show up. Just show up both weeks and
just show up. Last year we had one guy showed up, and I think so. We'll try to. No, we had more than one. Absolutely. No, sorry, lots of fun. If you're in Halifax, you're interested in getting together for a pint or anything.
All right. Well, hopefully on the next week's episode, we'll actually have an official time for Keith to announce. But with that,
it could happen. It could happen before the next episode. That's just it. This could be the one.
Man, this is really confusing for the people.
Yeah. Classic Loonie Hour.
Yeah, we apologize.
Events.
But as always, guys, this has been a splice. We do appreciate your support as always, and we'll see you next week.